So I'm sorry, Alan, so let me just, you're referring to the PCA memorandum, belief 4, correct?
INB 18.
Got it. Okay, I just want to make sure we're all on the
And
same.
that's our belief.
Literally
number
on the
4.
same page. Okay, so INB 18, belief 4. Okay. Everybody with me on that one? Okay.
And I viewed this one as there wouldn't be any debate on this one. I think this one is so obvious.
Comments about that?
Sorry, I didn't hear what Alan said.
I'm sorry.
He said there were probably no debates about this.
About which?
Internal
That
management.
belief 4,
Yeah.
internal management
Yeah.
is a critical capability.
Well, I think it's implied in what we've already said our beliefs are, because we've said for certain asset classes, different management styles are appropriate. Public equities, as a matter of policy, we've said internal management is appropriate. And we've also said cost is a guiding factor. And reason internal management is appropriate, one reason is because besides being better, it's also cheaper. So I think we've covered that point pretty thoroughly as a foundational belief.
Tom, if I could jump in,
Yeah,
Tom,
please,
I would
go
totally agree with you. I come back to Dana's comment. That's obvious to us in this room, but this is probably a good example where it wouldn't be obvious to the legislature, who has some control over some of your resources. And so by stating it explicitly, you've kind of made it plain language of connecting those two dots.
And it also is covered by the thoughts we've added to the preamble about
The pre-preamble.
taking direction from our, relying on our staff. But yeah, if you want to make it more explicit for that purpose, that's fine with me.
And I agree with that. And I think, again, this is sort of a dynamic process. We're doing this in 2016, and maybe some board 10 years from now will have this, process and this conversation, and that won't be as explicit. But to me, given the state of, institutional investors in general, and I do think it's important at this point to kind of have that be explicit in one of our beliefs, because it is, it's a significant shift, and I think it does have implications on the other beliefs, but I think it is important to kind of be overt in stating that. Any other comments about that particular? Okay. Do you guys want to go back to?
But with your permission, in deference to the staff, though,
Sure.
can we use my document?
Sure.
Okay.
We've
already gone through 1 through 4.
Well, I just want to make sure that's all right with the will of the committee. Okay. I've got Tom. Tom, do you want to jump in now?
Yeah, I just want to comment on about 5 and 6 briefly
5 and 6 on
Alan's.
Alan's. Okay.
Yeah. Governance and ESG sustainability.
Okay.
So governance, I'm not sure, is an investment belief in the sense that we don't, particularly, we're most active in a governance way in efficient public equity markets, as Paul pointed out, and it's kind of a corollary to our investment belief. I think it's an activity that enhances the value of our investment philosophy, because the whole idea of a governance activity is to be a policeman in the market and make sure we have fair rules in an efficient market, and that's a way you identify an efficient market, that there are common governance standards that the world applies. But it's not something that says when there's an efficient market, we put money into it in a passive way. So I'm thinking it's more a side activity to the investment activity, or a preamble activity, or a precursor, but not necessarily one of our investment beliefs. It's a precondition, I guess, and we wouldn't need our governance program if there were really strong, uniform governance standards set by the New York Stock Exchange and the SEC, for example. That's the far. Takes a stretch of the imagination to envision it, but yeah.
You're putting a lot of faith in human beings in corporate America.
Yeah. But if that were the case, then we would still believe in passive investing in public equities, but we wouldn't need the governance market. So governance activity.
It's like a lot of idealized worlds.
Yeah,
It's
yeah,
nice
I
on
mean,
paper, but it doesn't exist. And
after we
so-
get to the $25 minimum wage and compress
The living wage for everybody,
compress the inequality in income and everything like that, there'll probably be very good governance all across the corporate America.
Just a side note, it's interesting. Back in '84 is when the legislature is the one that mandated that you have a governance program.
Right.
And they adopted a law that said PERS and STRS would have a governance staff person. They only named technically sort of one back then. And they made that unit continuously appropriated so that you couldn't cut it out of the budget, and it was just always there and could grow. So it's kind of fascinating. It's one of the few places they stepped in the investment program early on. But that was the abuses back then. So.
Right. And it's important to remember when you talk about corporate governance, as a matter of law, your proxy is a plan asset. It is something that you have to have responsibility over as a matter of law and prudence. It isn't something that you just with discretion. And the goal in our number 5 was to recognize you have an important corporate governance policy, that you are an activist in terms of the regulatory environment and at the shareholder level, and that you care about issues beyond traditional financial metrics, and that those should be part of your decision-making process.
Yeah. So let me get Dana. Go ahead, Dana.
So Alan, maybe that's what we need to say.
Right.
And
That's what I meant.
that's our belief.
Beyond financial.
So maybe putting it that way, because there are pension systems that contract out with, I think, that contract out with someone else to do their proxy voting or that analysis and that type of thing. But we take it very seriously, and we have a strong program. So while I think the investments that are within the program that we call our corporate governance investment stuff, maybe that might not necessarily be part of the beliefs that we have, but the fact that we're activists within corporate governance, I think, is what would be more appropriate perhaps for our beliefs.
Okay.
So I have a tendency to agree with Tom, but I do think that I'd like to see us say something, because again, it's not just for us, it's for the world outside. And if we are talking about engagement and having those types of activities before we diversify or divest, then I think it's important to put that type of thing in it.
We'll work on expanding and clarifying that language.
Alrighty, thank you.
Lynn?
I just wanted to echo what Dana said. I think it's really important to address governance within the activities that and our beliefs that CalSTRS has. And I agree, Tom, in a perfect world, we probably wouldn't need to do it, but I don't see that world happening anytime soon.
Well, it may be that it's, what we're saying is one of the preconditions to the market being efficient is that there are very strong governance standards both in place and enforced, and that we make sure they're enforced.
I agree.
I think the key language is, to me, is in addition to traditional financial metrics, these ESG factors, governance. It's not just traditional financial metrics, but we believe engaging with the corporations that we invest in. We believe in thinking about climate change. When we think about what's going to happen in the future, that's going to benefit our fund at the end of the day. That we think that there's about financial value, but that's not measured in the traditional financial metrics. So
We'll work on the language and bring it back to you.
great. Paul?
Yeah, I mean, I think we need to have some more discussion about this, because I'm not sure I'm with you on that. And the reason is, again, it partly depends on whether we're talking about efficient markets or inefficient markets. But if we're talking about efficient markets, the work of SASB is very interesting, because the work of SASB says, by industry, we're going to try to identify what are material ESG factors that have an impact on the long-term performance of a company. And they're different depending on what kind of industry you're talking about. So, environmental factors are very important for an energy company and actually not material factors for a financial company. So, but they're doing a tremendous amount of really interesting work. But that does not mean that taking into account those factors in investing in a company means that you are going to invest in a better company that is going to do better than any of your other investments. Because our returns are based on how the market values the company. So if all of us up here look at a company and we all believe that it's going to do really well because it's taking account of these ESG factors, then the market price of that stock, when we want to buy into it, is going to be higher than a company where we didn't think that taking account of ESG factors is going to lead to a good outcome. And so the only reason, and this is sort of a foundation of efficient market theory, is the only reason that we would be able to do better investing in that company rather than another is that there isn't an efficient market, that somehow we have information that others don't, and therefore we've got a perception that others don't have about how that company is going to do. But that's not so if you talk to, I don't want to speak for SASB since Jack is a board member and he's sitting right here, but I mean, in my conversations with people at SASB, the work they're doing isn't to enable us to pick stocks. The work they're doing is to improve the market as a whole. To say that we move the whole risk return, balance for the better, for everybody, and that likewise engaging in corporate governance improves the market for everybody. So from that standpoint, it's really important. Those are really important things to do, but they're not because they give us an opportunity for active management. They give us an opportunity for better returns when we passively invest in an efficient market. Completely different when we talk about an inefficient market.
Alan.
It would be easy to get lost on this one, but I'm gonna take it from the other side of the trade. Effectively, I believe that the belief system is that there are companies that do not have good governance, that do not have good environmental or social policies, and by being an advocate, if they change, that in fact has the potential to improve the profitability of those organizations, which will in fact be reflected in the marketplace.
That's not inconsistent with what I said at all.
That's what I'm just saying. It's coming at it from a different angle, Paul. And so the reason, because I agree, a well-managed company is going to be reflected in the price of the stock, as will a poorly managed company. And the whole reason to have corporate involvement is to change corporate behavior in a way to become more profitable in the right way.
Absolutely.
Right. So what I think that comes to is to say ESG is important not because it gives us an opportunity to be successful active managers. ESG is important because it improves the performance of the market.
Right. That's exactly right. That's my belief.
Okay.
I don't want to say it's your belief.
I would
it's
agree
my
with that
belief.
statement completely. Yeah. Thank you, Alan. I've got Tom.
Yeah, I have a slightly different take on the role of these as investment beliefs. One is governance. So a company with governance performance in an index program may be underrepresented because they'll be penalized, but we don't exclude it from the index. So it doesn't inform our investment decision. And so we have to be, and I'm thinking we want to be very focused on this is how, these are beliefs about how we invest. It may be that we'll buy more if they improve their governance and their stock trades better, et cetera. But it's not because the governance improved. It's because it improved. It's recognized in the market, and they're a bigger part of the index. So that's governance, and I think so. I think it's not an investment belief, it may be another corollary belief that that it's very important for us to have a governance program to be a policeman in an efficient market. SDSG, we basically, have this special committee doing quite a bit of study about special pure economic returns to see where it makes sense to experiment and where it makes sense to see if we can make a policy decision that it is appropriate to vary from market norms or a standard index or something else. And so I'm thinking there's either we're just kidding with this committee, or we don't yet have a real belief on these points here, other than a general intuition that we all have that these factors ultimately will be important. And I'm not sure we'll be able to land on a really crisply defined belief, because if we could, we would have a very crisply defined investment program against them. And we don't yet. We may. I hope we do, but we don't yet.
We have an ESG policy, right? I mean,
It's intended to be a dialogue, and I think this is a great dialogue from a consultant's perspective. I don't know how the board feels. But in response to that is, I think you have in fact reflected it, and I think you have a corporate governance group which has a whole set of policies and a whole set of priorities that they actively pursue, which is part of the investment program.
Well,
and it's
excuse
not,
me, but we don't. I don't know who we're fighting with today, but we could. When we had our famous battle with Disney, we didn't divest from Disney.
I didn't. Divestment wasn't part of my conversation.
Well, I mean, but that's the point. I mean, it didn't change how we invested.
No, but what it would change, and I don't want to use any specific company as an example, to the extent that they have limited the ability of shareholders to impact decisions and they change their policies, and that they subsequently encourage shareholder involvement and focus more on whether it be executive compensation or environmental quality because they're an energy company. Those are ways of adding value. It has nothing to do with stock selection. It has nothing to do with being involved in the index. It has to do with being a corporate citizen. And I think that
yes, I don't disagree with that at all. I just my only I'd love to see all of this happen. I'm just saying, in terms of how we invest day to day, what we're asking the staff to do, what the staff is telling us what they do in that particular market sector, it would make no difference whatsoever about how they invest.
I agree with that completely. But it could
and so it's not an investment belief. But it may be another belief.
No, but it could change the result. In fact, if you make that a better company, then that's going to be reflected in returns over time if you believe the markets are efficient.
Yeah, I just think it's not an investment belief. It's
okay,
another policy. It sort of would fall under the category of things that, and I do think it's an appropriate thing, category of things that CalSTRS should do to improve the world, and one place is corporate performance. Okay. And it's an important thing to do. It's just not an investment.
We don't have to resolve this today, Madam Chair.
We're not going to resolve it today, Alan.
Sharon, I just want
Dana, let me. I've got Ms. Dillon and then Mr. Keeley. So Dana.
So something Tom said triggered a thought, and it was that what we're trying to do here is write beliefs about how we invest. I guess I was looking at it in a more global investment program picture. So, can you help me? Are we just trying to focus on how we invest, or are we taking a look at our bigger picture of the whole program and when it comes to the program?
I think we're taking a look at the bigger picture. Because we've been investing for a good 25, almost 30 years, my hope would be that the beliefs would somewhat match how we're investing. But if they don't, the next step is to come back and tweak how we're investing.
Okay.
So normally you would set up your beliefs and then implement your programs.
Okay.
We're doing it a little bit later.
Thanks. I appreciate
But
that.
I don't think you have to reconcile to specifically.
Okay, thank you.
I'm sorry, hang on one second. Harry?
Just want to make sure I understood the exchange between Emkin and Ms. Unterman. So, Tom, if I understood correctly, you're suggesting, you're stating that governance, et cetera, is obviously something very important and we should continue to engage with. It just doesn't fall from your perspective on the beliefs page, and it belongs in our policy. Part of someplace, an investment belief.
Yeah, investment belief is how do we instruct the staff, and how do we all agree that the staff should be investing our money day to day, and
That's,
and
more narrow.
but and everything else really is on that form of decision. I mean, I think there are a lot of other things that CalSTRS can think about, say, do, act on, that says how do we make the world better, and how do we make the world better for teachers, and how do we drive better corporate performance. But the fact is, in large cap equity in the United States, our governance program makes no difference on a day-to-day basis how we buy and sell stocks. And if that's the case, it's really not an investment belief. It's an aspiration for, it's something else we're doing to make the world better. And I really fully support it and think it's great. And if we want to have an experiment with a good governance index, then that's an investment program.
Is that all, Mr. Healy?
Yeah, completely understand.
Okay. Paul?
So Tom makes a very interesting point with respect to G. I'm not quite sure why it doesn't apply to E and S the same way. Inefficient markets.
Well, I agree.
Okay.
I think I said that earlier because with respect to E&S, we have this whole special committee doing a study on how do we try and adapt and how do we experiment in these areas to see if we can create an investment strategy to address these topics. And we're working on that, but we don't yet have a belief on it. We may next year.
Right, but what I'm saying is if good governance, if a focus on good governance is done for really good reasons, but not because they affect our investment portfolio, which is what I think you're saying?
Investment decisions, yeah.
Investment decisions, and the reason that they're not affecting our investment decisions, if they could affect our investment performance, then they might factor into our investment decisions.
Yeah.
But we don't factor them into our investment decisions because we don't think they can affect our investment performance, is what you're saying, I think. Then I think then I think we have to ask the same question about all of ESG.
I agree.
And whether it's an investment belief with respect to these are decisions that we should factor into our investment decisions because they will affect our investment returns, or whether we're doing them for another perhaps very good reason, but not related to how we think we can enhance our returns.
So my only disagreement, or the issue that is raising hackles in me is just this idea that the scope that you're describing, Tom, seems very narrow to me. And I guess I want to find a place between this narrow description and making the world better. In my mind, this is all about adding value to our fund. And it's all about if we can help improve the market by engaging on these ESG issues and corporate engagement. We improve the market, we add value to our fund. So I guess and we have policies and history as a fund of doing this over a long period of time. So to kind of say it's either a really narrow definition or we just want to make the world better and this is just kind of fluff off on the side seems, in my mind, this is integral to who we are at CalSTRS. We have a history of considering ESG principles. We have 21 risk factors. And I just kind of look at the world and how it's changing and the implications of the risk there might be to our fund moving forward. And I think those have actual, real, live monetary impacts on our fund. So I guess to me, with this investment beliefs conversation, going back to the preamble, it says these investment beliefs provide I know we haven't totally agreed on all this language, but these investment beliefs provide a foundational framework to all of CalSTRS investment decision makers to invest in a manner that reflects CalSTRS' unique view of the global investment markets and its vision for participating in these markets. And to me, that's not so narrow. So I guess I want to find a balance between a narrow definition and making the world better. I would love to make the world better, but my intention as a board member is to make CalSTRS better. I want to make money for teachers' retirement and do that in a thoughtful way, thinking about the implications in the future, and I think ESG is part of that. So, Mr. Emken, and then I'll grab the line.
Trying to focus on one of the terms and expanding on it. To the extent we're talking primarily about let's just say domestic equities, it's not going to change the way they're managed in the least because they're going to be indexed, at least to the greatest possible extent, in my opinion. The only way you can impact the performance of the underlying companies in an index fund is to change the way they're governed. And so to me, that is the active management when you have an index fund is not in figuring out the precise weight of a company in the benchmark. It's by trying to improve their approach to a variety of issues that you as a group have said are important and can have an impact upon their portfolio's performance, on that company's performance. And that is a form of management. It's not a form of active, traditional stock selection management, but it's a form of management. And you've got a staff of people that are doing it. And it's a major thrust of this institution for many years. And I think it rises to the level of being a belief because you commit a lot of dollars to it, you get a lot of publicity on it, and it's a matter that you have addressed on a multiplicity of occasions that it's important to the teachers.
All right, let's take our folks. Tom.
Okay, well, we go around in a circle about this. I understand what Alan said. I think it's really too attenuated to be an investment belief. I think it's a wonderful program. It's an important program. It's particularly important because because the quote efficient market needs a cop on the beat, and we're in part that. But it's not a belief about investing in an efficient market. It's a belief about enforcing one. So it's an important program. I don't think we're doubting that. I do think with respect to the E&S, we really don't, we all have an inkling about it. We all have an intuition about it. We have a special study going on about it, but we're not to the point where we have a belief about it, particularly as it relates to public stocks. I mean, if we had a belief about it, we'd have changed our indexing approach, and we haven't. Similarly, if we really had an investment belief about governance, we'd say, oh, I don't know, we wouldn't invest in two-class, non-voting class stocks, but we don't. So, I mean, I think it's maybe important to narrow the preamble because I'm not trying to do too much with this exercise because otherwise we'll find ourselves in very long philosophical discussions about everything the fund should be addressing over time without being able to give guidance to the staff or make a very clear set of come up with a very clear description of how we're guiding the staff to invest our money.
Harry.
This will be my last comment on this issue, and I don't think there's people are saying, I think essentially the same thing, but just saying that it belongs in a different place. It doesn't belong on this piece of paper in terms of belief, is what I hear Mr. Unterman saying. It just doesn't fall on this document. It falls someplace else. ESG, in particular G, has been a major thrust for this institution for many, many years. And from my perspective, will continue to be. a major thrust of this institution. We're a large institutional investor. We are the police in the marketplace. We have a role to play. What's the alternative? Be passive and think that everyone's going to do the right thing? That's like telling people driving the Ferrari on the 10 freeway there are no police officers out there today giving tickets. It might be a bad analogy. So it continues to, has been and will continue to be an important component of who we are at CalSTRS. We need to be very clear about that. I think what Mr. Unterman is saying is really just a distinction as to whether or not it falls on this piece of paper. That's what I hear him saying.
You know, I heard that. I think we just disagree on that. I mean, I've
Whether
definitely
it goes on
heard
the
the
paper.
message.
Yeah.
Yes. Yeah.
Well,
Got
let
it.
me just say one more
Yeah,
thing
sure.
on that. See, I think I understood what you were saying, and I just found it philosophically completely inconsistent with what we do.
With the preamp. Okay. Okay.
Because we have guided our staff to be index investors in public equities. And that, by definition, says, and we are really good at being pure index investors, that by definition says you don't think about governance. I mean, just pure and simple. That's the definition. I mean, we have other reasons to think about governance when we do, and it's an important program, but it's as an investment belief, and it's our most important and closest to core. We're saying when we invest in large cap public equities in the U.S. and Europe, our biggest investment portfolios, we don't think about governance.
So I think we're just going to agree to disagree on this issue, and then maybe we should just move forward. I've got Paul in the queue, and do you want to say anything, Alan? Or
Yeah, I think almost by definition, I come out in a very different position. Is when you're indexed, is your only way to have any impact upon that portfolio is in fact through corporate governance, and it's voting those proxies. It's not in stock selection. It's not in weighting the portfolio. It's literally getting involved at shareholders' meetings to try to change corporate behavior. And whether it's in this document or some other document, that's your decision. And to me, that's a secondary issue. The important thing is you said it's an important program. We think it's an important program. The board thinks it's an important program.
Yeah, and I think the other thing is that what Tom and I are saying in terms of its relative lack of importance in guiding investment decisions applies in efficient markets. It's not necessarily in inefficient markets. It's not necessarily in a decision about what private equity investments to make. But I think I think what I think I'm hearing is pretty much everybody. I haven't heard anybody stand up and say most of the conversation has been about G. I would add E and S into that ESG considerations give us the opportunity to stock pick inefficient markets. So the question is, if we all agree about that, maybe we do, maybe we don't, but if we all agree about that, then the question is, how important is it to continue? What is the impact on the market from, as Alan says, if you hold something in the index, then you can affect governance, and that might be an attenuated way of saying that it impacts our returns, but on the other hand, it may not be a completely zero impact on our returns. But I think those are the distinctions, it seems to me, that we need to spend, I think, some more time on are private versus public markets, efficient versus inefficient markets, stock picking versus improving and stock picking versus improving the market as a whole. And maybe it goes into a belief, maybe it doesn't, but I kind of think most of this is resolved by agreeing that there's a part of the market that's efficient. I think that kind of gives us the answer.
okay, I think we're ready to move on. Okay, go ahead.
You know,
Tom.
I think you have to look at the history of the governance program and what it was implemented initially 30-some years ago to address. corporate standards of behavior, particularly with respect to shareholder value, were markedly different. And in particular, you had entrenched management, resisting change that improved shareholder value. You didn't get the same instant sort of reaction to abusive behavior that the market now penalizes people for. And, so it played an enormous role in the 80s, particularly in making an index investing approach viable. 30-some years on, corporate standards of behavior have changed, responsiveness has changed, and things like that. It's still an important program, but I would say it's not a predicate to have the program to make index investing viable anymore. Where you could really argue in the 80s, it was. So I think that's how that informs my view quite a bit here.
I hear you. I think there's so much improvement still to be made. I mean, I'm still kind of, I don't have as much length of experience in the financial world, but I look around, I spend a lot of time at conferences, and I certainly see a lot of issues that I think are still kind of live that our corporate governance needs to continue to. So I appreciate that there's been a lot of work to be done, but we look at CEO pay and some of the behavior that's going on in some of the corporations we invest in now on the environmental front, and we have, I think, tremendous work to still to be done. So I'll just leave it at that. And Harry?
I agree with what Tom said. I also think looking forward, we have to think about the global marketplace, the emergence of the International Corporate Governance Network, and how governance standards across the globe are very different, and what role, if any, we can play in those markets and to improve corporate governance across different markets to the extent we can. So it's an evolving space.
Yep.
It's a space that has played an important role for us in the past. And I think what this board is saying, it will play an equally important role going forward.
Yep.
The disagreement is simply, does it belong on this sheet of paper or not, or does it just land in our policy?
Yep.
So I want to make sure that at the highest level we're consistent that this is an important area of focus for us. It's really where it belongs on a document.
Yep. Thanks, Mr. Keeley. All right, let's move on, Alan. What's next?
Okay. Under R's number 6 is the statement is that CalPERS can capture an illiquidity risk premium.
Wrong fund.
Whoa. Party foul. Party
6
foul.
of one, half dozen of the
Oh
other.
no! Oh no!
No, you didn't.
You were on
Just
this
say
side
that.
of the river, my
I've got
friend.
a gavel in my hand, Alan. So
Seen one, you
throw
seen
it at
them
his
all.
head.
That's
I,
wrong with you.
I apologize for that. CalSTRS preceded CalPERS.
We love our.
Yeah, thank you.
Okay. CalSTRS can capture illiquidity, and that's really real estate, private equity are the two areas that we would focus on. Those are illiquid markets. There is not public pricing available, and we believe that's where value can be added.
Tom.
I think it's subsumed in the first 2 points we've adopted, which is a diversified portfolio and different management styles are appropriate and strategies are appropriate for different asset classes. I mean, I think that's all one of the same. And I'm not, for example, I'm not sure our position in Apple is that much more liquid than our position in one of our big private equity funds at this point. So
The reason it's in there is for someone looking from the outside and they look at your portfolio and 20+% of the assets are illiquid assets. Why is that the case? That's the rationale.
sure, I mean, there are a lot of reasons. Diversification, and it includes liquid assets, looking for different management styles. I mean, there are a lot of reasons, and maybe you're saying at the core of them is the liquidity premium versus the ability to stay the long term, but I'm not sure that's the only reason.
Seems like it was the long-term investments.
Why don't we come back with some new language on that? Okay, the
any
next
other-
one on ours is belief 7, managing short-term drawdown risk impacts long-term health of the program. I think that's something that you discussed.
Right. At length in the
I wasn't
RMS
gonna, I wasn't gonna say
conversation.
ad nauseum, but I think
No, ad length is
ad length is more polite. But that's clearly a very important issue, particularly given the financial condition and the funding status of the plan. So we think that deserves to be an investment belief.
Well, to me, this is one of the beliefs that got me thinking about investment beliefs, because to me, as we were having this conversation about RMS, it seemed like oftentimes in our meetings, we would talk about, mitigating the downside risk. And so, it was, I think that one was pretty clear. Paul?
So I mean, it was great that we focused on that and that we continue to focus on it, but I think it's actually points out a more important, sort of more generalized belief, which is that we're investing to pay pensions. I mean, we're not investing to earn 7.5%. We're earning to pay pensions. That's what our purpose here is, and so one of the things we realized when we thought about that was that if we had big drawdowns, we might be at risk of not being able to pay pensions, and therefore we had to do something about it. But I think it's a larger issue, which should be focusing us on not what our investment return is, but what the status of the fund is to pay pensions.
But
So
that
do you
was
wanna
the
change
goal
that?
of changing, I think that was why we were going to go back to the preamble and
Okay,
include
well,
something on that
yeah.
in the preamble.
Okay, then that's fine if we have it up there.
So I think that is a strategy, not a belief.
The managing short-term
Yeah.
downside risk.
And it could well be, because, theoretically, we can have 3 great years in the stock market, be a little bit overfunded, and be more return-oriented than risk-oriented. I hope I'm here when that has happened. But it's really not a core belief that you'd say would always be present.
Well, today's my day to be oppositional, as I used to call my kids. And they were difficult, and I came up with the term oppositional. I think this is really a core belief. It was really fundamental to your strategic asset allocation, and it wouldn't change even if you had 5 great years. You would still worry about big short-term drawdowns. And it should be reflected in the overall picture of the total portfolio, and I think it's legitimate. But once again, these are your beliefs, not ours.
Why isn't that? I mean, why isn't that subsumed in that we believe in a diversified portfolio, and that a diversified portfolio improves risk-adjusted returns over time?
Because this brings into the equation not just risk-adjusted returns, but the ability to pay benefits in the funded status of the plan. It's really focusing on a different aspect.
I mean, I don't mind saying all these things, but I just don't see it as a core belief, as opposed to a strategy that we've adopted given our current funding situation and real rates of return. If you had an 8% or 5% 30-year Treasury, we'd think about this much different too.
Yes and no, and that is, over a long period of time, you don't get the average return. You might get it,
understand the point.
and what happens in the short term is not reflected in some of the previous beliefs, and this is just trying to emphasize that what happens in the short term could have a meaningful impact upon the ability to meet the objectives that the plan was created for. And that was the intent.
Yeah. But we're basically saying our fundamental belief is we're investing for the long term.
But
but we
while
don't
you
forget the
do
short
that,
term.
you cannot discount the fact that things in the short term can have a major impact. And
Because
you
if we
can't,
have a major
I mean,
downturn-
08 and 09 is the proof statement.
No, I'm not doubting that that's, it would be, that we have to protect ourselves, particularly in this environment and with this return profile. But
guess
I wouldn't think, but I'm also suggesting that 3 years from now, when we do our next asset allocation study, we may have a very different view as to the extent to which we'd be committing to an RMS portfolio for one reason or another, just as we had a very different view 3 years ago.
I guess I look at it from the context of the funding deal that we clinched last year or 2 years ago now. Has it been 14, 2 years ago? In terms of when we look at kind of the 30-year horizon, and it seems like the conversation has been, and our advisors have talked about, we had 01 and we had 08, and the question of, what would happen if in the next 5 to 10 years we had another major downturn. And I look at it from the context of sort of our long-term viability as a system and our ability to pay out pensions, that managing short-term risk should be, or the downside should be a priority or investment belief, something that we think about. But I hear what you're saying, Tom. It
depends what we're trying to.
It could be a strategy.
Yeah, it is, and it's a response to where we are today and where markets are today.
So we'll leave that one as point of conversation. Harry?
So, to Tom's point, if we were a younger system, if we weren't so mature, and we didn't have the cash flow issues that we have on a monthly basis, would we be focused in on this belief? Would you suggest that to us, Alan?
Probably to a much lesser extent. There's no question.
On one hand, we're saying we're long-term investors. On the other hand, we're saying, well, we're worried about drawdowns in the short term, but that's probably being driven specifically because of where we are in the cycle.
The cycle is less important than the financial condition of the plan. And that is, you have huge negative cash flow. That's projected to continue. Forgetting valuations, and that, in our opinion, nothing is cheap, and expected returns are going to be lower, in our opinion. You will not have the ability to reinvest new capital at lower levels. And those short-term drawdowns have the potential of significantly limiting your ability to meet your obligations. And that's unique. These are your investment beliefs. These aren't everybody's investment beliefs. And we believe, given your financial condition, this is something you should consider. But that's just our opinion, and you're the board.
Harry, you're hitting on a point. If we were a young plan and buying in, it's like anybody that has a 401k now, they always teach you your average cost buying in that drops in the market are actually a good thing because you can buy more. We're an average cost seller because we're so mature. It's kind of like we're the retirees, so now we're pulling money out, and drops in the market are bad because we have to pull out more of our assets when the markets drop. So
I think some of this is the question, are we writing the Constitution or are we writing a series of laws about how we're going to balance the budget over the next 5 years? And I tend to think of the investment beliefs as more the Constitution as opposed to the Budget Reconciliation Act for the next 5 years, or until the next asset allocation study is done.
So Alan, can we just leave that one as a question mark of whether it fits?
There's no right answer. I mean, if there was a right answer, everyone would say, oh, yes, that's obvious. There should be a debate, and you do have the program. The program's not going to go away. Right. And barring some fantastic event, which is hard to foresee, your financial condition is going to be a challenge for the foreseeable future. So this will be important. But whether it's an investment belief or a program, in my mind, that's your decision.
The difference in the analogy with the Constitution is hopefully the Constitution sticks around for a really long time. The investment beliefs are something that we're developing together as a board and staff and consultants. And like I said, 5 years from now, when either some of us are here or not, or another board could say, hey, we want to redraft these, So I'm not saying that it's going to look totally different than what we come up with. It's just a matter of, I think, the exercise is really to kind of, this is what's hard about being long-term investors, We're long-term investors with boards that change and staff that change. But I guess my point is this is meant to be sort of a guide for us for the next, 3 to 5 years, I guess, to sort of have a sense of this is what we can agree on as a board and staff and consultants. So anyway, Paul.
Yeah, I mean, I think the problem we're having is we could almost all of these things get narrowed down to diversification is good. There are some markets that are efficient and others that aren't, and costs matter. Right. And so to the extent that we go beyond those three, it's almost a matter of sort of emphasis of what do we want to point out that those three things mean. And I mean, I think the downside risk thing is really important, but I think what it really is if we're not investing in a risk-free portfolio, there is going to be volatility. And when you've got volatility, you have to manage the downside of volatility. And you also have to not get giddy when you get benefit from the upside of volatility. You have to recognize and live with and prepare for volatility. So that's, but on the other hand, I'm happy with the way it is now. We're taking it out entirely, actually not taking it out entirely. I like having something about that in there.
Okay. Great. Thanks, Paul. All right. Belief 8.
A couple more really quick ones, I promise you. Okay, that one's on leverage. And basically, leverage isn't good or bad. It has the potential to be either one. And in my opinion, this one, do you want to have a policy on leverage?
Okay.
All right, you don't have to address that right now.
All right. I don't see any questions on that.
Well, you want a reaction?
So
Sure.
push in if you.
I would think you're going to give me the same thing, which I wouldn't. And this one, I'm not going to fight with you.
I don't think we need a belief on leverage because I don't think we have one.
You don't think we have a policy on it?
I don't think we have, as a group, a belief on it at this point. I mean, I'm happy to add beliefs as we go, but
so I'm just
over time. But
well, you have an implicit belief in leverage because you have a levered real estate portfolio. You have a levered private equity portfolio. You have levered derivative positions. So there's a lot of leverage in the portfolio. So you have.
I know that. But if you went around the room and said, core belief, should we be borrowing or not? I'm not sure.
To me, this is one that I have no problem at all taking this one off.
I think it falls into diversification.
I'm just going to do a check-in because we've been hearing from just a couple of board members, and I guess in the spirit of trying to make sure we hear from everyone, I think our investment committees sometimes, we've got a lot of opinions, but I guess I just want to encourage other folks who might tend to be hesitant in chiming in or whatever. If you don't have an opinion, that's fine, but I guess I want to create a little space for people who we haven't heard from yet. It could be about Belief 8 or about anything else, but if there are other folks that it's okay if you don't, but I just want to create a little space for that. All right. Harry, did you want to? You were in.
Support, excluding leverage, just take it off.
Okay.
It's way too
No leverage.
complicated of a conversation.
Not that we don't have leverage. I mean, no leverage on the investment.
Fewer is
beliefs.
better than more, so I'm
Okay.
happy to delete.
Okay. Great.
The next one deals with,
We like it when it works for us. We don't like it when it doesn't. How's that?
we can make that a belief.
Yeah.
Bully.
The next one has to do with rebalancing and whether this one rises to the level of belief. I'm going to sign on with Mr. Unterman in this one. It doesn't have to. This could just be dealt with anywhere in the portfolio. So I'm going to take one off myself.
Look at you. taking one off of your own list. Okay. We love that.
Okay,
Self-editing, right?
last one on PCA's list.
What do you think about that one, Chris?
CalSTRS investment staff should add value on a risk-adjusted basis. I don't know whether that's a belief,
Right.
but I
Seems
do
like
know it's
almost
something
like an assumption
that's,
or
that's
expectation,
really
but-
important, because if you don't have a belief that that is going to occur,
The investment staff are chuckling over
then
there.
we need to have a pretty detailed conversation.
They're all mad at me because I said it's a hope.
It's a hope.
The board
It's
has
an
incentivized
expectation.
us to
It's an
add value.
expectation.
Notice
Right.
it doesn't say they will. The operative word here is should.
Should.
I have to tell you, in the employee survey that we did in the building, the highest rated question by an investment officer off the charts was, I am confident in my abilities. So, it's like when we're a confident staff, there's
Wow.
confidence, and then this crowd's like
And then
way over
there's-
here.
Got it. Okay.
We had a contest afterwards to see who could walk on water over to that other fund.
Any comments on belief 10? Do we think that's just, an assumption, presumption, or do we want it explicit in the beliefs? Harry?
I don't necessarily think it needs to be on our belief statements around how we're investing. It's explicitly stated in how people are compensated in the compensation policy.
And I think, we communicate that a lot from the board and from.
And if
so.
we no longer believe that, we'd have to change the compensation policy.
Right.
Instead of getting it on the belief system.
Okay. I think there's a sense of hearing none. Okay.
Just so I'm clear, we're going to come back with some language on those that still exist.
Yes.
I think there are a couple that still need probably a significant amount of conversation.
Correct.
But I think we made a lot of headway today. And
I do too.
Huge.
Good conversation.
Yeah, if I can, Alan,
Feels-
jump in. I think, so it sounds like the legal framework is a go, noting it's actually quoting maybe we should put it in quote, it's quoting the state constitution. We want to tweak the preamble a bit and break it into two different parts. A lot of debate about 1 and 2, so I think that's what we really need to come back and vet with you in July, is while it's fresh in your mind, 1 and 2. 3 was a go, I believe 4 was a go. And then the next big debate, which we may, if we can get to it July, great, or put off to September, is that whole corporate governance, ESG. Maybe if we can define what we mean by market efficiency, that will help us figure out how we word some of these other things. And then we'll have to put off to the fall the debate about number 7. But certainly on the PCA list, 8, 9, and 10 are gone. So.
Sounds good. That's a lot of work.
Which is good. We
just
really
did.
have to debate the first one, which is 1 and 2. What do we mean by market efficiency, and how do we term diversification?
Good. Thanks. I've got a couple of folks. Harry?
It's when you said you got it in the preamble, specifically that we wanted to explicitly state that it's a delegated
Yes.
approach and philosophy
Well,
and system.
this was longer than a 90-minute item, so I'm going to go back and listen to the earlier comments when we were on that. I heard a couple of things. One, to add the delegation, but then there was some other discussions about what's the purpose of the beliefs? Why are we writing
How
this?
narrow is the scope?
purpose of the fund
How-
of the investment program is to pay for benefits.
Yeah, and the purpose of the fund is to pay for benefits, is what Alan just said. Okay.
Nora?
So I've been processing some of the questions around the ESG, and so I think I'm a lot around where you are falling into the scope. And so I'm wondering if, when the information comes back, if it's not under the investment beliefs, where does it fall under? Because I do think that we have a certain responsibility to the teachers and sort of this global perspective. And so I would be interested in knowing sort of where does it fall under if it doesn't fall under the investment beliefs.
Thank you for reminding me we have the last slide, because that will help you with that.
Before we go to that, can
yes.
I grab Tom and then
Sure,
we
okay.
can go to next steps?
So-
Go ahead.
When you talked about 1 and 2, I thought it actually, or I think of it as 3 points that sort of resolve themselves, that we don't get into a definition, trying to define when a market's efficient, that we're sort of allowing
Yeah.
the staff to guide us on that. that, the influenced by expenses, and that let the staff, again, getting guidance from the staff about appropriate management styles as we diversify into other asset classes. And it avoids trying to define which markets are efficient and when the efficient market theory applies and all that sort of stuff, which we all could talk about for a long time. And I'm sure it's easier to coalesce around those simpler points.
I think the primary goal is going to be to get rid of jargon and make it in plain English so that it's very clear on what the intent is as opposed to really changing the substance.
Yeah.
Thanks. So Chris, these are our next steps,
Yes.
and I had some questions because we can read what's kind of sort of the idea of what we're going to do. We know that it might change. One of my questions is, so the stakeholders that are in the room, what can they expect for the summer in terms of how we're going to get? Because I know in October we've talked about in the offsite having some stakeholder engagement. What is the summer?
We need to vet that out.
Okay.
I think Alan, when we first started this, had talked about surveying the board during the summer months and like a survey monkey. I put it up there. These slides are.
I'm talking about the stakeholders, not the board.
Yeah. So sorry.
Okay.
The stakeholders, we've been chatting with them, but as we go through these steps, we will bounce it off and get their feedback. It fits a lot with what Nora questioned, which is if you keep the beliefs this high. That's what was one of the uncertainties with them, is how detailed will the beliefs get. The fact that you're pulling out some of like leverage and staff value added doesn't warrant a belief. Then they'll realize these are very high level beliefs. They have some concerns about other issues. That's after we complete this project, we will be moving into a rewrite of the 21 risk factor ESG policy. And that's maybe where we'll get into more granular, some of the tougher issues on E, S, and G. How do we believe it? What do we think about manager selection, that kind of stuff.
Great.
And so my hope is still that we'd be able to have a first reading for you of a policy by November, but this is open.
This feels good. This feels like a good pace.
Sharon, if I could just comment on Nora's question, and I mean, I really think this goes to the question important about how we deal with ESG in this context. I think we're, as a board, all thinking that the S and G, the E and S are particularly important and a particularly challenging fiduciary question at the same time. And we're working it. I mean, that's an issue that we're really working. Mm-hmm. So I think the point it says to me about the statement of investment beliefs is, we don't have a belief on it now. We're studying it. It may be that we form a belief after we, do something with a recommendation from the special committee and we test it for a while and all that sort of stuff. And then we have a belief and we can add a belief. But I don't think we have a degree of certainty about the soundness of that intuition that we all have, that we'd say that's a core belief that will guide us in all of our investing activities over the next 4 or 5 years. I think we all have a hope, an inclination where we want to come out, but we have to be guided by what numbers tell us.
I guess I have so much to say about that, but I'm going to hold my tongue and wait till July. Okay. But I think we need to have a deeper conversation about this, and that's obvious. And I know Paul's clear. I want you to hear, but I guess I'm consistent. I'm aware of time and all that stuff, and I don't want to rush the conversation. So I guess I want to say this process can take as long as it takes. Yep. So this calendar is great if we make it great. There's no rush on this process. To me, the conversations we've had today are really important, and I have learned so much today just trying to synthesize, and I think just the conversation alone, I think, is part of the intent behind this exercise, is for us to kind of start, putting words to what we think, and then at the end of the day to kind of agree on where we agree, and then we have to let other things go that we don't agree on, what belongs in our investment beliefs, what doesn't. But Paul, I didn't mean to cut you. Do you want to pull out? Or?
I'm with you.
Yeah.
The only thing I wanted to say was
sure.
that I don't really think the
the work of the subcommittee has been to research whether we have an investment belief about ENS.
I agree.
That's
You're
what
right.
the investment
Well,
beliefs discussion
Well,
is.
let me be clear on it. I mean, I think it shows that we don't have a belief, because if we did, we'd be changing our index, and we're not.
But Tom, I guess my thing is we've been doing ESG. We've had a policy on this for a long, long time. So to me, I would counter and say we have these policies in place. We have Ann Sheehan and her team. So to me, that underscores that we do have a belief.
Well, but we haven't taken Exxon out of our portfolio.
I agree with you, but there's a lot anyway. So I don't want to keep having this, but I think we're raising it. This is a good conversation. This is what a healthy board does: is we debate these issues, and so we should continue to debate them. We should get because we just look at it. It's sort of like looking at the elephant from different perspectives. We have different ways of looking at it, and that's good. That's healthy. So we want to continue to do that. I think this is one particular area where we've demonstrated over the last several years. There's just a lot of different views on it. So I think at some point we have to just sort of agree on what we can agree on and what we can't. So does that sound good to everyone? I'm sorry, I messed up the whole section. So we had Paul, and then I think Harry, did you want to say anything else? Go ahead.
Wanted to just add that my final comment on this matter is the subcommittee that has been meeting, from my perspective, has been extremely informative relative to the performance of some of the decisions that we've made. And it has shown tracking error or the lack thereof and what the performance has been to date on some of the quote-unquote special mandates. And I think that's going to be helpful to us to help solidify positions and beliefs. Because after all, our beliefs really should be data-driven from a fiduciary. So I think that's where we have to kind of thread the needle a little bit between what Tom was saying, is what our inclinations and hopes are, and our fiduciary responsibility, where we can show that there is no drag on the portfolio or the trade-off is this. It can only help us with establishing what we want to do on a forward-looking basis.
Absolutely. Great.
Thanks, Sharon, for
Thanks, gentlemen.
sharing this.
I need a 5-minute break because I need to, I'm chairing a meeting. So let's take 5 minutes and come back at 3:15. How's that?